The biggest mistake traders make is treating an order block like a guaranteed entry. It's not. An OB is only a reaction zone. Confirmation is what protects traders from getting trapped. And now, after watching the full setup, you can probably understand why this model can be both profitable and risky at the same time. Because if confirmation fails, the entire setup can fail too.
The first thing I marked was this bearish order block sitting above price and sell-side liquidity resting below. Now, most traders instantly short from the order block blindly, but I've used this concept many times before, and price often creates inducement first before mitigation. So instead of rushing into a sell, I waited for liquidity to form first. Then price started building inducement here. This was important because inducement attracts traders early before price delivers toward premium zones like this bearish order block. The moment I saw liquidity forming here, I already had an idea that price could move higher first before the real move toward sell-side liquidity begins. So here's where I took my first trade. I bought price from the inducement area directly into the bearish order block. Now, I'm not saying this type of execution is completely safe, because this trade is still risky and based on anticipation before full confirmation. But I've used this setup many times before, especially when liquidity clearly forms below premium. Now, this is where most traders get trapped badly. The moment price taps the bearish order block, they instantly start selling blindly without waiting for any reaction. But after using this concept many times, I learned that not every order block is valid, and some completely fail. So instead of selling blindly, I waited for confirmation first. I wanted to see if sellers were actually defending this premium zone, because confirmation is what separates reaction from trap. Then price started rejecting aggressively from the bearish order block, and that became my confirmation. The moment price showed buyer weakness and sellers started taking control, I entered my second sell trade. My target was simple, the sell-side liquidity resting below price. And after that, price completely collapsed toward the sell-side liquidity. This is exactly what happens when premium gets respected. Buyers get trapped and sellers fully take control of delivery. I have seen this type of move many times before, and this trade became part of my successful trade executions. So the biggest lesson from this setup is simple. Never treat an order block like a guaranteed entry. An order block is only a reaction zone. Confirmation is what protects traders from getting trapped. A lot of traders see price touching an order block and instantly enter without waiting for any reaction. And that is exactly why many setups fail. Even though I've used this concept many times before, I still understand that this type of execution can be risky if confirmation does not appear. And after watching this full setup, you can probably understand why this model can look very profitable, while still carrying real risk at the same time. Because if buyers stay strong and sellers fail to defend the premium zone, the entire setup can completely fail. That is why risk management always matters more than the setup itself. Follow Discount Trader for more advanced trade executions like this. And remember, the goal is not to blindly copy every setup. The real goal is understanding when liquidity, confirmation, and market delivery actually align together. Because that is what separates random entries from high-probability executions.